Hey, good morning. This is episode 15 of Three Clowns, Thursday, April 24th. We've got oil in a 5-day rally, tech getting hammered yesterday, Microsoft down 4%, but the defensive stuff's actually flying, and the NASDAQ futures are green, so basically, the market's deciding everything at once, and we're here to figure out which direction actually sticks.
Yesterday, I saw a man jogging with a full birthday cake. No box, just commitment. I respected it more than most CEOs.
That is the most beautiful thing I've heard all week. The sheer physics of keeping the frosting intact while hitting a 6-minute mile. That guy has a clearer exit strategy for that cake than most of the traders I talked to yesterday.
Yesterday, I watched a guy parallel park for so long the meter expired before he finished. Which I think legally means the car belongs to the street now. Same energy as the cake. Just commit early and live with the consequences.
That is the sunk cost fallacy in its purest form. Just watching your dignity evaporate 1 inch at a time because you refuse to just find a spot 3 blocks away. Well, yesterday I spent 20 minutes trying to fix a leaky faucet before I realized I didn't even have a wrench. At some point, you're just performatively struggling so the neighbors don't think you've given up.
Okay, so the cake guy and the parking guy basically summarize what happened yesterday. You commit to something, reality changes, and you just keep going. And that's kind of what the market's doing right now, except it's arguing with itself about which direction to commit to. Oil's had 5 straight days up because Iran talks are falling apart, Brent's sitting near 104, and energy stocks are bid. That's the commitment to higher prices. But then Microsoft gets taken out 4%, mega-cap tech's de-risking, and you'd think that kills everything. Except the NASDAQ futures are green this morning. AMD's up 7.5% on earnings, so the selling yesterday wasn't fear, it was rotation. The weird part is the defensives also ripped. Utilities up 2.7, staples up 1.7, but gold actually fell 1%, so nobody's hiding in fear, they're just moving money around. And look, we went 0 for 3 on our calls yesterday, which historically means we're about to accidentally call something exactly right, so that's actually encouraging. The market's still deciding, and so are we. Lululemon got taken out 13% on revenue miss. That's the consumer telling you yoga pants aren't recession-proof anymore. Crypto had a full Tuesday, Bitcoin and Ethereum both down, Coinbase and MicroStrategy bleeding with it, which is just contagion when the macro story shifts. Intel options are pricing in a monster move post-earnings, which means traders are basically saying the stock's still deciding what it wants to be. Man Group just lost $6 billion in a single redemption, and an activist is pushing Voya Financial toward a full sale. That's not volatility, that's confidence leaving the building on 2 separate floors. Meme trading is back after a rule change because apparently we needed that. China's doing that weird split thing where Chinext keeps climbing but Hong Kong tech is lagging, which tells you domestic investors still believe the story, but everybody else is hedging. Rocket Lab down 6, Stifel's CEO warning about a liquidity mismatch in private credit yesterday after close, and Vanguard just flagged that prediction markets are getting exploited. So basically, we've got small cap pain, credit getting nervous, and a whole new gambling apparatus that regulators didn't see coming.
AMD up 7.5 is the market quietly admitting there's a second supplier now. Not equal, just real enough that NVIDIA's pricing power isn't a religion anymore. Microsoft down 4 and futures green. That's not panic. That's people selling the thing that worked to buy the thing that might. Which is fine until you realize both trades are still the same AI story wearing different hats. Tesla down 3.5. Yeah, gravity continues to be undefeated.
Tom, that gravity comment, it's the only law of physics the market still respects. Well, that and the fact that you can't ignore a 5-day oil rally when Brent is knocking on the door of 104. That is the oxygen for the inflation fire right there, and the Fed is just standing there with a bucket of water that's getting smaller every time a headline about Iran talks stalling hits the tape. The gold move is what really got me, though. It fell while utilities and staples were flying. That tells you this isn't a run-for-your-lives moment. It's a hide-in-the-cash-flows moment. People aren't buying gold for a catastrophe. They're buying utilities because they've accepted that the 10-year yield at 4.32 means the cheap debt era is over, and you actually have to find a business that makes a real dollar.
All right, let's go to the tape and see what actually moved the needle. All right, so oil's up 5 straight days, and we're sitting at 104 in Brent, which, on the surface, looks like a geopolitical risk story. Iran talks are stalling, Trump's rhetoric is hindering progress, the Strait of Hormuz stays constrained. But here's what actually matters. The traders pricing this aren't panicking about supply shock. They're pricing a physical tightness that lingers through summer, even if talks eventually restart. Lloyd's data shows a shadow fleet moving crude on the margins, but volumes are down. And the futures curve is in backwardation. That's the market saying near term is tight, later loosens up. The bull case is straightforward. Oil stays bid into Q2 and Q3. Energy equities keep the bid. And if this extends, inflation expectations creep back up and you've got a real problem for rate-sensitive growth. The bear case, and this is what the tape was actually showing yesterday, is that equities don't crater with oil anymore because investors are betting the actual demand hit from $104 crude is manageable. So you get this weird decoupling where the energy ETF rallies and utilities rally and the broad index barely moves. That's not complacency, that's the market parsing a supply squeeze from a demand shock. The real risk is if something breaks the logic. If we get hard data that higher energy costs are actually crimping margins or consumer spending, then that decoupling snaps and you've got a real problem.
If power's the constraint, not chips, then oil at 104 just quietly taxes every data center build. Are we underpricing how much that bleeds into AI margins by Q3? Or do they just eat it and call it scale?
That backwardation is the market basically signaling it expects a recession to do the Fed's dirty work and kill demand later. Alex, if that tightness keeps headline inflation pinned up through the summer, doesn't that just evaporate the soft landing narrative and make a June rate cut basically impossible?
Yeah, so here's the thing. If oil stays elevated through June, headline inflation probably does stay sticky, but the Fed's already accepted that headline noise doesn't drive cuts anymore. They're watching core and labor. The real killer for a June cut isn't oil at 104. It's if we get surprised hot payrolls or service inflation that actually moves the needle. What kills the soft landing isn't energy costs. It's the margin squeeze Ray's worried about. That's the actual demand problem. But here's what's interesting. Utilities and staples rallied hard yesterday, which is the textbook defensive rotation, except gold got absolutely hammered. That's not fear, that's pure factor rotation. Investors rotating out of duration and into yield, which means they're not pricing a recession. They're pricing higher for longer rates and I want income now. If this was real panic, gold would be bid. So the tape's actually saying oil tightness is manageable enough that we don't need Fed cuts, which ironically makes a June cut even less likely.
Gold down, defensives up. That's not fear, that's people choosing cash flow over hope. Higher for longer isn't bullish for long-duration tech, it just hasn't been enforced yet. At some point, the math stops being theoretical.
Okay, so Microsoft's down because JP Morgan basically said the entire Magnificent Seven is priced for perfection, and there's no margin for error. The crowding is real. And when you've got that much capital chasing the same narrative, the first sign of friction and people rotate out fast. But here's what's actually interesting. AMD just printed blowout earnings on data center. That's the same AI CapEx story, same customer base, same tailwinds. Except the street's treating it like a discovery instead of confirmation. That shouldn't be a surprise. NVIDIA's been the assumed monopoly for 18 months, so any AI upside gets priced into NVIDIA first, then TSMC, then everyone else gets to surprise to the upside. AMD's not getting rewarded because the trade just cracked, it's getting rewarded because it was left for dead, and the earnings actually prove the thesis is broader than one stock. The real signal here isn't that Microsoft is broken, it's that the cap-weighted index got too narrow, and the moment you got forced selling in the 3 or 4 megacaps, the AI story didn't die, it just redistributed. This is actually healthier than the panic you'd see if AMD printed weak and Microsoft fell anyway. The question is whether that rotation sticks, or if Microsoft's down 4% and bounces on any sign of stabilization. Because the damage isn't to the AI thesis, it's just to the assumption that there's only one way to play it.
AMD's a challenger the same way a second coffee is a meal. It's helpful. It doesn't replace the first one. NVIDIA still owns the software stack, and that's the part nobody rips out once it's in. One good quarter doesn't undo 18 months of CUDA lock-in.
Tesla's down 3.5% on Musk comments about demand softening, and consumer discretionary got taken with it. But that's just gravity, not new information. The stock's been repricing lower all month, and this is just the confirmation nobody wanted to hear out loud. Lululemon's 13% crater on the revenue miss is actually interesting because it's not a macro signal. It's a brand-specific execution story. The Reddit obsession is real, sure, but the street's using this to finally admit that athleisure normalized and Lulu can't charge premium multiples for single-digit growth anymore. Man Group lost $6 billion in a single redemption, and now Voya's getting activist pressure. So you've got asset managers getting squeezed from both ends, redemption risk on one side, governance pressure on the other, and frankly, this is what happens when your fee structure can't survive a sticky rate environment. Meme trading's back after the rule change, and that's just someone opened the door and retail walked through, but this isn't a bull signal, it's a plumbing signal. It means volatility's about to get more episodic. China's Chinext is crushing Hong Kong names because domestic investors are pricing government support, and foreign investors are still hedging geopolitical tail risk. So you've got two different narratives in the same country. Crypto got absolutely demolished. Bitcoin, Ethereum, Coinbase, MicroStrategy all down because when macro shifts and the duration trade breaks, the leverage comes out of everything at once. Rocket Lab dropped 6%, which is just collateral damage from the broader risk off. And Intel's options are pricing a huge post-earnings move, so traders are literally braced for the stock to do something violent either direction. That's the tell that the street doesn't have consensus on what their turnaround actually looks like yet.
Intel options pricing, something violent, is just the market admitting it has no idea what the business is quarter to quarter. That's not volatility, that's identity crisis. Meme trading, back at the same time asset managers are bleeding $6 billion. One side's playing, the other side's getting fired. China splitting into two tapes. Domestic buying policy, foreigners pricing geopolitics. That's not inefficiency. That's two different realities clearing at once. Crypto getting hit at 77,000 is just duration with better branding. When rates stay up, the story doesn't matter. The leverage leaves anyway. And Tesla? Yeah, it's the expensive car company discovering gravity in slow motion. Turns out demand curves still slope down.
That Lululemon crater is the one that actually makes me sit up. If the top-tier consumer is finally flinching at those price points, it means the higher-for-longer weight is finally filtering up from the subprime auto borrowers to the people who actually drive the GDP bus. And the China divergence is wild. You've got domestic retail buying the state support promise, while the big global money is treating Hong Kong like a radioactive zone because of the tail risk. It's two different bets on whether the government even has a floor they can actually hold. Then you have the meme traders coming back just as the leverage is getting ripped out of crypto. It's like watching people run back into a burning building to grab the furniture. It's a plumbing signal, like Alex said. Retail has nowhere else to put their yesterday's winnings because the actual macro environment is getting so restrictive. Yesterday proved that when liquidity starts to dry up, people don't just exit, they get erratic.
Ray, you've been tracking the structural shifts underneath all this. Walk us through what the footnotes actually tell us about where we are.
All right, so the footnotes today are actually pretty heavy, even for a Thursday. We have to start with this oil move because it's getting weird. Brent is sitting at $104. It's up 5 days in a row, and the oil ETF jumped over 4% yesterday alone. Normally, when energy spikes like that, the S&P 500 starts sweating because it's basically a massive tax on every consumer and every shipping company in the world. But equities are just, they're barely moving. Why the decoupling? You have to look at the futures curve. We are in deep backwardation right now, which is a fancy way of saying the price for oil delivered today is way higher than oil delivered in 6 months. The market isn't actually pricing in a long-term energy crisis. It's pricing in a localized panic over these Iran talks stalling. Investors think this is a temporary geopolitical spike that will fade, so they aren't dumping their tech stocks yet. They're treating $100 oil like a one-time fee rather than a permanent change in the cost of living. But then you see this divergence in the safe plays. Yesterday, the defensive sectors were absolutely ripping. Utilities were up 2.7%, and staples were up 1.7%. Usually that's the duck and cover trade. But gold fell nearly 1%. It closed at $431 and change. That tells you this isn't fear positioning, it's yield positioning. If people were truly scared of a systemic collapse, they'd buy gold. But because the 10-year yield is hanging out at 4.32%, they'd rather hide in utilities where they can actually collect a dividend. Gold doesn't pay you to wait, and in this macro environment, nobody wants to wait for free. It's like we've forgotten how to hold an asset that doesn't have a coupon attached. Well, and then there's the big one. Man Group had a single institutional redemption of $6.1 billion. One check. That is massive. You don't see numbers like that unless a sovereign wealth fund or a massive pension is liquidating a position because they need cash elsewhere. It's a huge signal that the hedge fund redemption cycle is speeding up. People are looking at their alternative portfolios and realizing they need liquidity more than they need alpha right now. And that leads perfectly into what the Stifel CEO was yelling about after the close regarding the private credit liquidity mismatch. See, these private credit funds have exploded in size. They lend to mid-sized companies that the big banks won't touch. The mismatch is that the investors expect to be able to get their money out relatively quickly, but the underlying loans are totally illiquid. You can't just sell a loan to a medium-sized factory on an app. If we see more of those $6 billion exits like Man Group just had, these private credit funds are going to have to gate their investors, meaning you can't have your money back even if you ask. It's the kind of plumbing issue that stays invisible until it suddenly floods the whole basement. And finally, Vanguard is coming out against these prediction markets, calling it financial exploitation. It sounds dramatic, but they're worried about the feedback loop. These markets where people bet on the Fed or elections have grown so large that they're starting to move the actual underlying assets. If a whale or a group of exploiters manipulates a prediction market to show a 90% chance of a certain outcome, it can trigger algorithmic selling in the real bond or equity markets. It creates a tail wagging the dog scenario where the bet creates the reality. And Vanguard is basically saying this is a threat to actual market stability because it's not based on economic data. It's based on who has the most chips at the betting table. It's not just a game anymore. And the gold ETF is already down another 0.2% pre-market to 430. So that yield over fear positioning is holding right into today's open.
Ray, that Man Group redemption and the private credit gating thing, I want to make sure I'm not catastrophizing here. If we actually see a wave of that and some of these funds start locking doors, does that create a feedback loop where more people panic and try to get out first? Or are we still small enough that it stays contained to the alternative space?
Well, the problem is it's rarely contained because of how these big institutions manage their total pile of cash. If you're a pension fund and you suddenly can't get your money out of a gated private credit fund, you don't just give up. You sell whatever is actually liquid, which means dumping your S&P 500 ETFs or your treasuries to fill the hole. That's the real feedback loop. The illiquidity in those private, medium-sized factory loans forces a fire sale in the assets we all own. And that's the contagion the Stifel CEO is shouting about. It's not a separate pool. It's all one big bucket of liquidity until the tap runs dry.
Yeah, we've reinvented bank runs, just with better branding. It's not alternatives when everyone reaches for the same exit door at once.
Yeah, and that's the thing nobody wants to say out loud until it's too late. Liquidity's an illusion until everyone needs it at once. Tom, you've got the semis set up, right?
All right, Nerd Corner. So you've got two semiconductor companies, both AI plays. And the market is treating them like they're in completely different asset classes. AMD first. Closes 305, trades 328 pre-market. Call it plus 7.4. That's not just they beat. That's the options market being offsides. Because going into the print, implied vol said, we expect a move, but not that move. So what happened? The call wasn't just good, it resolved uncertainty in one direction. And that's the key thing. Implied volatility is not about excitement, it's about disagreement. It's the price of we don't know. AMD had elevated vol going in. It's AI, it's crowded, expectations are high. But the range was still anchored to a thesis people broadly agree on. Data center growth is real, MI300 is gaining traction, hyperscalers are spending. The debate was, how much? Not, is this even working? They answered, how much, with a number that forces models higher. So vol collapses after the move because the distribution tightens. You've converted uncertainty into direction. Now Intel. Intel is not a how much story. Intel is a what are you story. Options are pricing a big move tonight, and that's not because people are excited. It's because nobody can confidently bound outcomes. Foundry turnaround, gross margins, CapEx intensity, government subsidies, product competitiveness. Each of those can swing the equity independently. So the options market just throws up its hands and goes, fine, big range. It's not volatility as opportunity. It's volatility as admission of ignorance. And structurally, that's the difference. AMD's vol is event-based. Earnings come, you resolve it, vol comes in. Intel's vol is existential. Earnings is just one checkpoint in a multi-year question. And here's where it gets interesting for the broader semis trade. AMD just confirmed that AI CapEx is not just NVIDIA's party. It's spreading. Hyperscalers are buying alternatives. The spend is real, it's scaling, and it's not bottlenecked to a single vendor, even if NVIDIA still owns the software stack. So the AI trade de-risks, but only for companies already inside the flow of dollars. Intel is trying to reroute itself into that flow, and the market is saying, we'll believe it when we see it, and until then, we're charging you maximum uncertainty premium. So you end up with this split market. One set of semis trades like infrastructure, predictable demand, modelable growth, tightening vol after earnings. The other trades like biotech, binary outcomes, narrative swings, massive implied moves because nobody trusts the path. Same sector, completely different math. And the uncomfortable implication: if AI CapEx is as strong as AMD just showed, then Intel's problem isn't the market, it's execution. Because the money is there. It's flowing. It's just not obviously flowing to them.
So here's what I'm wondering. If Intel comes in tonight and the numbers are fine, or even good, does vol actually compress the same way AMD's just did? Or does the market still treat it like, okay, execution checkpoint passed, but we're still not convinced you're actually in the flow?
It compresses, but not like AMD. You'll take the edge off the tails. The they're in trouble right now scenario gets priced out. But the multi-year dispersion stays because one clean quarter doesn't solve foundry economics or product cadence. So vol comes in just to a still high baseline. It's relief, not resolution. Ray, anything you want to add on the semis picture?
I love that volatility as admission of ignorance line. But with the 10-year yield sitting at 4.32 and oil at 104, if these stable growth semis are starting to trade like infrastructure, doesn't that make them way more sensitive to the discount rate? Does that premium actually survive if the cost of capital keeps climbing? Or do we eventually see the everything is AI trade hit a wall because the macro math just doesn't pencil out anymore?
Yeah, in a vacuum, higher rates should compress those multiples. But that's assuming the cash flows are fixed. AI names are still revising up, the numerator's moving faster than the denominator. So the market's basically saying, fine, discount it at 4.3, just make the earnings bigger. Alex?
Yeah, and that works until it doesn't, which is exactly why we need to figure out what the market's actually pricing for the rest of the semis complex today. Let's make our calls. All right, so yesterday we went 0 for 3. Again. Tom missed on NVIDIA, called down 3, got down 141. Ray was close on the dollar, but not close enough, off by 19 basis points. And my 10-year call, which I'm still not entirely sure how I'm still getting wrong after this many episodes, was also wrong. I had sub 425 and we closed at 4.294, which is above it. So we're now on what? A 5-episode skid of this? This is becoming a reverse signal indicator. Tom, you're up. What's the call today?
Yeah, semis are doing that thing where one guy actually shows up to the party and suddenly everyone's like, no, we're all healthy. AMD prints real data center growth, and the market immediately extrapolates it onto NVIDIA while pretending Intel isn't about to say something unsettling in about 12 hours. The move here is positioning into that read-through, not the print itself. The streets underweight the idea that AI spend is still front-loaded right now. It hasn't rolled over yet. It's just rotating between who gets paid this quarter. So, NVIDIA closes today above 202. I'm wrong if the 10-year keeps grinding higher through 4.35, because then this just turns into duration pain and nobody cares about semis having a good personality.
Tom, I love that. NVIDIA has a good personality. It really is just a beauty pageant where the judges are all staring at the 10-year yield instead of the stage, isn't it? You're right on the edge, too. That 10-year yield is sitting at 4.323 right now. So you're giving yourself, what, less than 3 basis points of breathing room before the semis lose their charm? Bold move. Yesterday, I was actually digging through some old Fred data on the mid-70s, just looking at how gold and oil used to dance together when inflation got sticky. And it's weird, right? Usually 5 days of oil rallying like this. I mean, Brent is knocking on $104. Usually that's the buy gold klaxon for the inflation is back crowd. But gold isn't catching the bid. The gold ETF is actually down pre-market at 430. Why? Because the market isn't scared of inflation as much as it's scared of what the Fed has to do to kill it. The yield on the 10-year is the only thing that matters today. It's acting like a magnet for all that liquidity, and since gold doesn't pay you a coupon, it's just getting left behind in the rotation. So, the gold ETF finishes today below 428. I'm wrong if the dollar index loses its momentum and starts sliding early in the session. That would take the pressure off the metals and let them breathe again.
Ray's got it backwards, though. Or not backwards, just incomplete. Gold's not lagging because of the yield spread. It's lagging because there's no fear yet. The dollar's strong, sure, but it's not panicking anyone. The moment oil starts looking fragile, and Brent at 104 is still just knocking, not breaking through, gold becomes the hedge again. Right now it's just a carry trade victim. So here's what I'm watching. The QQQs are up pre-market on the back of this AMD beat and the rotation into megacap, but Tom's 10-year buffer is already getting thin. Intel reports tonight. If semis hold into the close, it means the market's already priced in that Intel says something survivable. My call is the QQQs close today above 658. I think the AMD momentum carries through the Intel event and that last push into close is real. I'm wrong if the 10-year grinds through 4.35 and we start seeing that duration rotation actually bite into the growth names before the close. All right, Intel reports tonight, so Monday we find out who actually called it. Have a good weekend.